You mentioned, Sonali, that you're interested in financial education and literacy. How did that come about, and what are you doing about it?
Well, I think over the years, with experiencing clients, going to clients, what we saw was that a large portion of the clients still remains male.
Even though
male.
Male, okay.
Even though there are women who are probably earning equally and are participating in the workforce, but when it came to making investment decisions, they were passing on those investment decisions to their spouses or father or brother. And the key gap was that they didn't think that they were financially literate, that they don't understand what's going on. Even the basics, even if they want to get into investing, they don't know where to start. And as a result of that, they decided to stay away from it. So it was one such instance that a client and his wife, the wife was retiring, the client was continuing to be a doctor. And I said, I will spend time with you to, we'll meet every week, we'll figure out some basics. And it took us about 3 weeks of meetings, so 3 times that we met. And she was completely up to speed with everything that was going on. Going forward, our work became a lot easier because she was available, she would understand things, she would ask the husband, she would sit in all of the meetings, get everything done. And I think that was a trigger which was a game changer and an eye-opener, that it doesn't take too much for bringing them also up to speed, just some basics if we know. It can really benefit the wealth manager. It can definitely benefit the family. On that, we do have initiatives for clients' wives at Anand Rathi Wealth, where we do some basic workshops on basic terms. We run certain workshops for children. I also do something on the side. I have like a small page on Instagram called the FemPower Project, where I put up videos that try to explain complex financial terms in as simple a way as possible. Simplicity is key. Yeah, that's where it's going. There's a long way to go, as I think we were discussing with Anita as well. But then a start somewhere.
Great. Okay, now let's get into the middle of let's get straight into our discussion. So I've seen over the last 2 or 3 decades, there has been a shift as far as the attitude of the global Indians is concerned. Okay. And obviously, the nature of the jobs are changing, the nature of businesses they run is changing, regulatory changes are happening here. So if I were to ask you, Anselm, you've been here for a few years, what have been the significant changes that you've seen? And then, and what do you think will happen over the next 5 years?
First of all, thank you, Prem, and thank you for having us here. And I think to everyone in the audience, if you can give a big round of applause to Prem, the Cafemutual team, for putting this together. Also, it helps wake you up after lunch.
Thank you so much.
So thank you for that. I think you're right. And I think, as Ashok mentioned, over time, we've seen an evolution of many things that have happened in the UAE. From the mindset of the client coming in here, changing from one, where someone was coming in to look at this place as a 3-year, 4-year, from a 3 or 4 year term, to everyone who's looking at this as, how long can I wait here? Yeah. And along with that, the financial infrastructure that has accompanied it, whether it be in the form of regulations or in the form of the number of regulators, that has also evolved. So earlier there was just one, there was the central bank. Central bank then split into insurance authority, into ESCA. Now we've got central bank with the insurance authority, we've got ESCA, we've got ADGM, we've got the DIFC. So the infrastructure from that side has also evolved, and it has forced two things. One, us as a professional wealth management firm to be able to evolve, make sure that our team, our staff are following those kind of regulatory requirements, the best practices, as well as on the other side, the manufacturers have also had to sort of come out with solutions that cater more and more to the needs of the evolving landscape. So that, I think, sort of in a sort of nutshell, would summarize the journey so far. And if I look at the second part, I mean, 2030, that's a very interesting destination. Today, if we look at the way that technology is playing a part in the evolving landscape, be it artificial intelligence, be it just the sheer number of wealth tech, fintech platforms that are there, it is easy to see that the future is going to be tech-driven. There are certain characteristics and requirements that I think clients are expecting, especially when we're looking at it from a perspective of wealth transition. As we will see in the next 5 years, most of the Gen X will sort of be handing over to the millennials and the Gen Zs, and they're all digital natives. So I think there's a fantastic opportunity for change. There's a lot of technology-enabled tools that will come in. AI is a game changer. We can go into it a little more in detail. Yeah. But it's exciting times for sure. The advisors and the combination of what's happening, I think, create an unbeatable proposition for us.
Okay. Pratik, I come to you. Anselm has spoken at length about how technology is going to transform and how the next generation will take command. What are the other changes that you foresee happening by 2030? I want to talk about their attitude towards risk. I want to talk about their attitude towards India versus the rest of the world. I want you to focus on these two.
Sure. I think to understand in a perspective, we need to have some numbers in hand. So the Indian financial wealth today is about $1.1 trillion. Over the next 5 years, it's expected to go to around $2.3 trillion. Okay. The global financial wealth today stands at about roughly 305 trillion. Oh, okay. And over the next decade, we expect approximately 1/3 of it to be handed over or to be passed on to the next generation, yeah. The Gen X, the Gen Z, the millennials. So their behavioral aspects are going to be extremely different, right? So let's understand that in a perspective. So one is the economic factor. This is a demographic factor. So there is a demographic change that's happening. Now their affinity towards technology and how they want and what they prefer, it's going to be very different from the previous generation. So to the best of my understanding, obviously it's very difficult to know the future. Even if I knew the markets for next one day, I won't need to be here, right? But I think people would demand a lot more. From a relationship-based advisory or wealth management, things are going to change into a tech plus relationship plus data. But where do you see, you're talking about attitude. The attitude, I think people could look for more variety. Okay, people could start looking favorably at more newer asset classes. People could start demanding more of tech involvement. And obviously, the expectations would be far different. Okay, the expectations would be multi-jurisdictional, multi-asset class, tax advice, right? So these are things that we look at, and obviously there's a lot to talk about, but to understand in a nutshell, people need to change. Knowledge has to be the forefront of your advisory business. Without knowledge, without the attitude of being a legacy trainer, you will fade away into oblivion, is what my firm belief is.
Okay. Okay, Sonali, you have an almost exclusively an NRI clientele, am I right?
Yes.
And how do you see your clients? Because the last time when I met you, you were also talking about people who had retired and were settling down here. Yes. So in the next 5 years, where do you see this particular generation, and what do you see them doing?
So if I kind of have to put into perspective, I'll give a very India-centric perspective. We always divided it into two parts of what it was, say, 10 years ago to what it is now and what it will be 5 years from now. 10 years ago, if you met the global Indian, it was a flex to not invest in India, if I have to put it. I have my investments outside, and that's what works for that global Indian. We had to convince people to be sending money to India, investing in the India growth story, all of that. The last 4 to 5 years, we've seen a shift in that happening, where the growth story is not something that you have to sell to the global Indian. They want a piece of that, for sure. But the how is now the question. And in the next 5 years, what we do see happening is a lot of the global firms as well. We, of course, exist and continue to enhance our offerings to make it more technologically forward, more centric, operationally friendly. But other firms as well are looking at India as a central destination which investors will want as a part of their portfolio. Two big asset classes that we see a big interest from the global Indians: real estate and equity. Real estate as well. The ticket size of real estate that the NRIs are looking at is a higher ticket size. And they are investing not only for returns, but also from a perspective. And that's a big shift that's
Okay, Sonali,
back.
is it Indian real estate, or are you talking about real estate in Dubai?
No,
are you talking about
India,
equity?
real estate in India.
In India, okay.
NRIs sending money back to India and buying properties in India. Okay. There's been an increase from about 10% of the total sales that were taking place in real estate in India in 2019 to that being almost 20%. In 2025, and that's expected to go up by 2030 as well. And the ticket size of what they are buying is also on the higher side. From the clientele that we manage, we have seen an increased trend of NRIs returning back to India in their retirement phases to live back. So that's UAE would probably be an exception, but I'm talking about other NRIs from other places. Middle East forms a good cushion of where people wanting to stay back, but other Western countries, we see that people are wanting to move back to India and therefore are making these real estate purchases.
Okay. That's interesting, Sonali. So tell us about the difference between the mindset of the global Indian who's based in the Middle East, particularly in UAE, and the mindset of the global Indian who's in the western part of the world. How are they two different?
There's a very clear demarcation, and there's also a very unique need that we as wealth managers managing different jurisdictions have. The biggest advantage that the global Indian out of the Middle East is there's no tax complication, right? So you do have access to the global markets, but everything you can access in a tax-free manner. So it's a lot easier to talk about return and ease of transaction, ease of access to assist a global Indian who might be based out of the Middle East. The Western world is a whole other story. Why? Because of multiple tax calculations and complications that come in. Every product having a different kind of tax requirement. So advisory is not only based on data which is return driven, but also what are going to be the tax implications, giving tax advice of what's the best way to structure those investments. So you want to access India, but how do you want to access India in the best or most tax efficient manner? An example that if there's somebody who is sitting out of the US and there has been an increased interest in US Indians, whether US citizens or NRIs, to invest into India and send money to India with all of the uncertainty that is taking place in the US, right? A regular mutual fund could deliver that 16, 17, or 20% return. But for a US Indian, there is an additional tax of almost, in addition to the 12.5% that they pay in India, they are going to pay almost 25, 30% additional in the US on an Indian mutual fund.
Oh, I didn't know that.
And an added tax compliance called PFIC,
Correct.
which deters most of the investors because
Correct.
it's very difficult for CPAs to keep filing the requirements.
Fatka.
Correct.
No, it's called PFIC.
What is that?
Passive,
Passive fund,
foreign
in
investment
foreign
company.
investment.
Oh, okay.
Yes.
It requires extra compliance.
Correct.
It requires extra number of filings
Okay.
per fund that you hold.
Okay.
So unless, and most of the CPAs, I'm talking from a purely US perspective, most of the CPAs are also not prepared to file. And that's why they discourage the investors to look outside the US geographies when it comes to investing into the global funds.
So how do you fight that?
Because
you said that you are looking, you are in US.
Yes.
And you have a couple of people also
Sure,
there.
sure.
And you cover the market quite extensively yourself.
Right.
So how do you fight this?
I think we
Because-
closely work with a couple of CPAs in our panel. That's the first thing. I'm not trying to be a racist, but let me put it this way, that the white Americans do not understand PFIC that well. I don't want to generalize, but that's my experience. So you pick up a couple of Desis, preferably the Patels, have them on board. Now, once you're compliant, that's the lion's share of the problem taken care of. Okay? Now comes the additional tax responsibilities. Then it's quite easy to tackle. Now, if I talk about, say, India per se, okay, it's one of the highest growing economies and the highest recognized, the highest in the top 5, obviously. So, the government thinks we're going to grow at 6.8, the consensus is 6.6. Let's take it at 6.5. Add another 4.5% inflation to get, nominal returns of 11%. Add about 2 to 3% premium for corporate profitability, you are there at 14% returns, right? Now, optimistically, rupee could depreciate by 2%, pessimistically, rupee could depreciate by 3%. So you're still looking at a 10, 11% kind of pre-tax returns. Now, post-tax, if it still translates into 8% or 9%, over the longer period of time, and don't go by what S&P delivered in the preceding 10 years till 2024, because sometimes data is a badass, it can create all kinds of wrong notions. But over the longer period of time, if you have to play the power of compounding, you have to keep India out of your portfolio at your own risk. So yeah, there goes your explanation. I think you have to be, you cannot have a home country bias. That's our constant, focus that we keep telling people. You cannot have home country bias. Prashant touched upon a point that India has been one of the least volatile markets. Yeah. So understand even from the volatility perspective, beyond a particular threshold of wealth, people's objectives change from return maximization to wealth protection and other things, succession planning, etc. So India can be a great asset allocation call. And that is what I think the focus has to be.
Okay. Pratik made a point. It's not just about returns. It's about preserving wealth. Yep. It's about helping them do succession planning. Yep. And so, Anselm, in your company, how do you go about, because you're a major player in wealth management, how do you handle these particular things? How important are they in your offerings to your clients?
So it's extremely important. I think if you look at the way that the transition is happening into the next generation, the concerns of the families, a lot of it is around passing on wealth, is on creating that legacy, is on being able to create structures that allow for these in an efficient manner. Like my colleagues mentioned, tax is a major consideration. And of course, we are not tax experts ourselves, but we do work with a panel of tax experts to be able to provide access to clients for those aspects of their wealth structuring. But that said, there are many tools on the insurance side that we use and that we apply to be able to create these structures, be it using trusts, be it using foundations or the like, to be able to give clean structures so that wealth can be passed on easily. That's one of the things that we've seen is that the global Indian is today a lot more exposed, not just to assets in India, but to assets in multiple places, multiple countries. So they do require a level of sophistication compared to previous times, and this is only going to increase because as we look at the next generation, and if you look at it from two perspectives, sorry, I'm going to just sort of go in a little more detail. So if you look at it two perspectives, one is we've got the generation that is moved on, and then we've got the generation after that. So if I take an example, our children, my children, for example, may not be as may not identify so much with India as they will identify with the UAE or if they are in another geography. For them, structuring the assets and having to navigate some of the things that would be required if they have to have a lot of the assets in India is very difficult. So from a wealth management perspective, that is something that we also try to work with clients to be able to make sure that how do you make sure that one, the structures are correctly put in? How do we make sure that when the next generation is coming in and they probably don't have as much of an attachment to India, what is their portfolio look like and how does that sort of conversation happen? So I would say those are some of the factors that we work with.
Okay. Pratik, you alluded to something, and Anselm also actually kind of hinted at that. So many different geographies to look at, so many asset classes to be looked at. What is happening currently? Just give us an overview. What is the favorites of the global Indians sitting in Dubai and in UAE? What are their current favorites? What is it that they like? And what is it that they're doing?
I think the current favorite should be something else. I have not interviewed people post-October. The reason, obviously, is that you must have seen the most touted asset class falling like a pack of cards and now trading at $89,000. Without naming that asset class, I think that had been that had been the favorite amongst the millennials. And although obviously it's a perspective, I don't think of crypto as an asset class because I cannot value it. I am a man of very limited knowledge. I understand cash flows and I understand valuations. I don't understand demand supply. So that's why we have kept it out of the portfolio, even though there was a lot of pressure from the newer set of investors and asking, why aren't you looking at this thing? Also, I think there has been a favorite amongst people and particularly in the UAE over the last 4 to 5 years is real estate. Now, obviously, this market is a pretty volatile one. People who have seen 2014-15, people who have seen 2009 or 20 would actually exercise caution and not buy at any price. We have seen that buy at any price principle has not worked anywhere in the longer term. So that's another favorite. Obviously, if you get the right valuation, you get in, you play the rental yield, you play the capital appreciation. But again, valuation, jaise, I think in India, people say that no one's above God. I say no one's above valuations, right? Nothing's above valuations. So that's the current favorite. But however, what's happened is that of late, people are realizing that the easy ways of making money over the longer period of time is not quite a possibility. And there are times when that exuberance in the market kind of makes people believe that, they're invincible. And any asset class could make money just because it's shouting from top of the hoarding, it's shouting through your WhatsApp screen. And nowadays, 99% of the information that you get, which is an information overload, is probably noise. If you cut it out, only 1% is relevant. And in that relevance, you would still find that longer period investors who have been in the markets for long still prefer the power of compounding, still prefer equities over the longer period of time. They understand how it works. A lot of fund managers, especially people like Prashant, whom I have immense respect for, put a lot of emphasis on cash flows, right? So yeah, the current favorites could be private credit. The current favorite could be PE investing. Everyone wants a piece of tech. I see a lot of platforms having tokenized investments into tech companies like SpaceX and there are a flurry of investors who want to take part in that. But from a perspective, I think there's a risk that everyone needs to understand. And as long as the focus is on the risk to reward ratio and what amount of returns make me happy, the noise will get cut over the longer period of time.
Sonali, from what I know about what Anand Rathi does here in Dubai, you don't sell any of these products, no cryptos.
No.
You are not into private credit, not into AIFs, not into alternates. And you focus completely on India,
Yes.
and you focus largely on mutual funds.
Absolutely.
How do you then serve your clients? Don't they ask for a more holistic approach?
Yes.
There are other people who are offering far more larger bouquet of products, and I'm talking about services included in that, whether it be succession planning, tax planning, or creating structures and all that. How do you fight the battle then?
So firstly, we don't do just mutual funds. We do look at strategy planning at a balance sheet level.
Okay.
So we set return objectives for the entire balance sheet,
Okay.
which includes their foreign assets.
Okay.
And we arrive at what percentage is allocated to India and what percentage would be allocated to their foreign assets.
Okay.
We don't have expertise on giving advice on the foreign assets. We set certain targets and guidelines of what can be done with the foreign assets, but we don't have expertise to give advice on the foreign assets. What we are key players to manage their India assets. So given that we look at NRIs alone, all of them do have a certain portion that is already allocated to India, which is not possibly managed in the most efficient manner. So we add efficiency there. We also look at tax planning at a global level. We have in-house tax expertise for that. We look at estate planning as well. Currently, all of that is more India-centric, but since we are looking at the NRI space at a larger base, we are looking to add more global taxation, global wealth planning, not to do it in-house, but basically find partners who would be experts on doing the bit, who have similar value systems to what we at Anand Rathi Wealth do, because we have managed to create a certain credibility, which is data-driven, and a trustworthy relationship with our customers, long-term relationship with our customers. So we are looking to partner for the gaps that we don't do. We're not looking to ever go into, say, I will advise on US markets. I have 250 product team members sitting out of Mumbai who are analyzing things that we are doing, which is only 2 products. When we have the capability to do that for other products and have arrived at this is actually good for you for your overall return objective, which may be 14 or 15%,
Okay.
that is when we would end up doing that.
Okay.
So,
Okay, great. Anselm, there is a belief as you go up in the wealth hierarchy of Indians here, global Indians, the allocation to India reduces. The higher up you are in the hierarchy, the lower is the allocation to India. Is this correct? And if it is correct, generally hazard a guess as to what would be the allocation of, let's say, the ultra HNI global Indian and the professional this thing.
Sure. I think it also depends, on the amount of time that the person has been away from India. So that I think plays a part in that decision.
How?
So,
Meaning
I mean, from an asset class perspective, today, if I take you through a story, right? The first time someone comes in, there is a very heavy skew to India.
Okay.
So the new investor here probably has a better understanding of the Indian ecosystem, the Indian markets, a lot more exposure there. They start with something that's familiar, but the attractiveness of the access to the global markets kicks in quite quickly, and that's also a story from a wealth management perspective that why don't you diversify?
Yeah.
As time passes, we see that that skew tends to go in to probably a level when I would say, I mean, I'm going to hazard a guess over here, but it would probably end up being about a 20-25% of the portfolio at a certain level. So it will sort of move gradually over time, as well as from the affinity to India, I would say. So, you know, for the first generation, it would be a lot higher. For the next generation, probably tends to end up being a little lesser. But that's the sort of trend that we see. On a lighter note, one of the things that we've found with, you know, NRI investors is they will, when they want to, they won't invest until they've watched a YouTube video, they've seen 3 tweets, and then they've, you know, put a message on the family WhatsApp group and got a got a message saying that yes, this is good. But there are multiple factors that tend to influence how much of the family is there in India, how much of it is sort of related to the assets there. Yeah. But if I had to sort of generalize and give you an answer, it sort of goes down that trajectory.
Okay. Pratik, what is your experience? I'm talking about what is the allocation of the ultra high net worth global Indian and
Sure.
take another segment, which is the top professionals, CXO.
Sure.
So what?
Yeah. I think what's happening is that the aspirations have changed, and that's why more you climb up the ladder with respect to the wealth, you start having people who have lives tied up to multiple jurisdictions. People want a second passport, people want another citizenship, people earn in dollars, have a lot of spending in euros, cannot avoid India because that's where they belong, and they have assets over there. So what's happening is that as you climb up the ladder, your need for diversification into alternative asset classes go up. I'm not saying it's the right or wrong thing to do. It's a perspective. And also the exposure, also qualification criteria. Most of them become accredited investors and hence have access to specialized products.
Accredited investors here.
Yeah, accredited investors here, beyond a particular threshold of wealth, when they qualify to invest in particular asset classes or products, the hedge fund strategies. So obviously these start forming a part of their portfolio. And the hedge funds is just a strategy. It could be equity long, it could be long short, it could be commodities, it could be anything. But what I'm trying to tell you is that from a typically India-focused portfolio around mutual funds and ETFs, people start becoming cost conscious, tax conscious, okay, technology conscious, and aspirationally they want to hold certain asset classes as well. So that's how it changes across the spectrum.
Okay, something which everyone is interested in knowing about. How will artificial intelligence, how will digital transformation affect the advisory business?
So I think there are certain things about the advisory business will not change, which is, you know, a big part of the advisory business is setting goals, setting goals and aspirations for clients. That is something that will not change despite AI being there. The other bit is the emotional hand-holding, right? Converting somebody from a equity fearing to understanding equity is a long-term investment. That bit is something that only an advisor or a human will be able to do.
Will be able to do, but the investor may not want it that way. He may think he's competent enough today to research, and no one thinks that I need you to control my emotions. Yeah. That's not, I mean, I know that advisors play a very important role, but that's not the way most people see it.
Absolutely, you know? And that's why there are behavioral coaches, and advisors need to become more knowledge partners and legacy coaches over the coming period of time and move away from typical product selling into managing people's behavior, right? And there are cognitive biases and emotional biases. Cognitive biases could be handled by giving more information, showing the bigger picture, etc. But emotional biases are very difficult and you need to adapt to it, right?
So coming back to, sorry, Sonali.
Please.
Please.
Yes, those bits for sure, as I think Pratik very rightly mentioned, that the way you will, relationship management itself will will continue to be a key of how you actually become an emotional partner for your clients. Because providing data or information already, right? Chat GPT gives the answer before you've even attended a meeting.
Yeah.
He's given you a set of questions that he wants answers to.
Yes.
He's already got his set of answers and he's verifying whether you are saying it correctly or not. But again, a very big thing that advisors need to take cognizance of is that advice can no longer be on the surface. On the surface, research can be very much done by AI. We have to go deeper into the problems, deeper into the data, into analytics, into something that possibly, if you have cross-border interactions, AI can tell you what is going to be your tax implication if you are a UAE resident who might be moving now to Australia. But if there are multiple complications, I have some family members here, some family members there, are there ways that I can structure my wealth utilizing presence of family members in different parts of the world? So there will still be a lot that the advisor can bring to the table. And advisors who are able to utilize AI to replace the mundane tasks and give that out will be the ones that will come out on
So they
top.
can transform their own practice in a manner
Absolutely.
of speaking.
Yes.
They can make AI do the grunt work.
Grunt work, exactly.
Okay,
Training
fine.
AI to do that.
Great.
Yes.
No, great answer.
So,
Yeah.
if I may,
Please.
I think today there's an app for everything,
Yes.
but there's no app for trust.
Yeah.
Right? I mean, you can try, but you can try coding it, you can try to develop it, it still needs to be earned the old-fashioned way,
Which is what?
which is being able to sit down in front of a client, being able to sort of be transparent, be ethical, be honest, be able to showcase that you have his best interest in mind.
Okay.
But that needs to be supported by technology. If you're not using technology, you're going to be obsolete. Very, very clear. The message is very clear. I was at a summit yesterday, and so a small example.
Sure.
And there was a company that was demoing the use of technology to be able to sort of interact, engage with their clients. We are used to live chats on WhatsApp, right? As a message comes across, you type the message back. What they're using technology for is to be able to customize and personalize the response with a video. So you've sent a text message, the response is coming is a video replying to your specific message in a language of your choice. So it is all generated on the fly using technology, using AI to be able to provide you with that experience where there is so much of convenience, there's so much of personalization that is happening. So I think the advisor that does not get with technology and does not implement and use technology to enhance the service, the support, the proposition. I mean, all of my colleagues have mentioned, right? AI can do so much more with data, the analysis, the depth of the sort of the data set that it can sort of analyze is beyond the sort of capabilities of normal human beings. And by 2030, this is just going to be exponential. I mean, if you think about in the past, I like to say BC being before COVID and AC being after COVID. If you look at around the time of COVID is when first ChatGPT and LLM sort of came into the consciousness. And today we are at a stage where it has grown to such a level where the intelligence that it offers is frankly, I mean, someone in the past would look at it and say this is magic. In the next 5 years, in fact, by 2027 is when they are predicting that we will see artificial general AGI, and the capabilities then will be completely different. So advisors, wealth managers need to adapt and adopt technology into every aspect of their business. They need to bring in the human and the personal conversations. Relationships will be extremely important to be able to manage and maintain. And I agree, they need to be financial coaches to their clients, utilizing all of the technology.
Okay. So You were saying something about...
No, I just want to ask you a question. How many times have you tried to get a problem solved on phone trying to reach a customer service executive and got frustrated by keying in the buttons and never being able to reach a human? Right? Technology fatigue is real, which we are in our optimization for AI, we are failing to look past it. Okay? At some point of time that people could go back to looking for a more human touch, a human face, a real experience and a real interaction, especially with respect to matters related to finance. An advisor should be happy with the role that AI would be playing, certainly if his mind is in the right direction, because a lot would be taken off his table, which he's struggling with today, with respect to data, compliance, onboarding, tracking different markets, analysis. Now, what AI could do is probably give him very pointed data sets, which he could infer from his judgmental capability, knowledge, and experience. Now, AI is only looking at data historically, right? And then it is projecting on the basis of some algos and flowchart. It would still project it on the basis of, this is happening, yes, yes, no. This is happening, yes, no. You understand how it works. That's where a judgment, sound capability, knowledge, experience of valuations, of economics, of turnaround cycles of markets, it's going to be very essential for capable advisors. So that's why a slightly different take on AI. It's not all gloomy for people. Real people with knowledge, with experience, formal training, credentials will actually find it easier to advise people in an AI-driven world.
Okay. In fact, one of the session immediately after this is going to be conducted by my friend Nitin, and he is going to be talking about the impact of artificial intelligence on the investment advisory business. And he has a few very dramatic stories to tell. Okay. So we have just 3 minutes left. So I would quickly like all three of you to tell us about what do you think will be the global Indian in 2030, and how will your profession be different? How will you be serving him? Him or her, rather.
So I think the global Indian is going to be looking at more allocation to India in 2030, more than what they are currently.
Okay.
What they're looking for is ease of access, away from the complexity of transactions and operations of India. So anybody who can provide a seamless access to India is going to come on top. And yeah, we are preparing for that.
Globally mobile, technologically native, some home country bias, with expectations from their wealth managers to be technologically smart, not be fussy about adopting technology, and institutional level governance. Tax and cost efficiency, multi-jurisdictional tax, asset class management, and advisory capability. That's the expectation from the global Indian economy.
So it's going to be a very, very tough job in another 5 years from now, because all these things are pretty complicated. Anyway,
so they've covered a lot of it. I'll just say that the global Indian client wants an advisor who's high-tech, high-touch, and preferably available on the weekends.
Okay. So with that, I come to the end of this particular discussion. Thank you, the three of you, for sharing your insights so freely with us. Been wonderful talking to you.
Thank you very much, Mr. Khatri. Thank you to my panelists, Sonali and Anselm.
Thank you.
And thanks to everyone who had a patient hearing, especially after a heavy lunch. And thank you all. Thanks, Sunita.
Thanks. Thank you so much, Prem. That was true.